Hey, good morning. How's everybody?
Good morning,
Good
Professor.
morning, Professor. We're doing great. Well, I am.
Great. How are you, Jodianne? How are you, Naomi? At least I can, I can see that two people are
Good morning,
uh,
Professor.
doing well, and Angelica. So three people are doing well this morning. So I see nine people here and collaborate. And let me check how many people are in today's forum. So I see 11, right? 11. So, well, hoping that, yeah, one more person is joining. That's gonna make it, 10. So I'm, still waiting for one more person. Now, so in our last class, we talked about, what um, factoring, uh, uh, what factoring was, right? And we talked about what uh, where the word factoring comes from. I mean, this is important to know because um, the concept of factoring, um, you can look it up in dictionary, or I mean, you can look it up, you can Google up, and it will tell you, I mean, it will explain, basically an act of, it will explain it as an act of selling the promissory note or invoice or accounts receivable in general to a bank or a financial company, which is a third party to the original transaction, right? Um, but that definition doesn't exactly explain why it is called factoring, right? The origin of the word. Why? I mean, in English language, we can, we just call that factoring without thinking too much. It's basically, in mathematical terms, is called, simple discount. I mean, in financial mathematics, mathematical finance, right? In mathematical finance, it's just called um, simple discount, right? Simple discount. But then, if it is simple discount, a simple discount means, discounting using simple interest rate. But then where does the word factoring come from? And you try to kind of interpret it in your to the best of your own understanding and knowledge. Oh, because it is like discounting it by the factor of something. Uh, Now, so if the discount, let's say the maturity. Oh no, I think I will need to blow it up. Oh no, 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 no. Now it's only getting smaller. Oh my. So how do I make it bigger? Hmm. Well, I'll just have to. I guess I'll just have to. Okay. So let's say the promissory maturity value of the promissory note. All righty, I'll just have to use this. That's too much. Okay, so let's assume that the so let's say the maturity value of the promissory note is I'll just make it $1.1 million, right? 1.1 million. 1.1 million, right? Why? I mean, this is the result of, because this is the result of principal and interest, right? So the principal was 1 million, and with 10% interest rate, so that's 0.1 million, right? With 10% interest rate. Okay. And then so discount rate and the discount rate is, let's say, 15%, right? And time left to maturity, right? This is the time left to maturity. In other words, this is the time left when this company took the promissory note to the bank, and so that's the they can take it to bank at any time, but let's say at that point the time left to maturity is 90 days. Let's say 90 days. Then the bank will use these two, right? The discount rate and time to discount this maturity value. So then the symbol I should use should be, okay. D stands for proceeds, okay, proceeds, which means, that's what you receive after discounting. That's what the company receives after selling that to the bank. So basically the idea is, you will have to multiply it by 1 minus dt. So in this case, then, is 1.1 million times d times t is 0.1. So think about it. It's going to be 15%, so 0.15. That doesn't look like. 90 days is, oh, remember all rates are annual, so you cannot just multiply it by 90. You must first convert 90 days into years, which is not a difficult thing. It's 90 over 360. You might wonder, why 360? Isn't 1 year 365? There are two types of years. One, in simple interest rate, one is ordinary interest rate, which is 360. 1 year is 360 days in ordinary interest year. In the exact interest year, 1 year is 365 days, of course. But unless otherwise specified, all right. Unless otherwise specified, the default is ordinary interest year, right? So we can simply use the calculator to do this. So the whole thing will be oh, that's 11 million, not so 1. Okay. Times open parenthesis 1 minus 0.15 times. We know 90 over 360 is, it's the same thing, 9 over 36. I mean, it's a there you go. It's going to come to the whole thing comes to 1 point 58 1,058,750. So the point is, this so this is what the bank gets. I mean, this is what the company gets, right? And the difference is what the bank takes, right? Remember, at maturity, right? 90 days later, the bank will present it to the issuer, right, of the promissory note. So the bank will collect 1.1 million, but bank will pay out to this company 1,058,750, right, in advance. So the difference is almost about 40K. That 40K is the bank's cut. That 40K is called bank discount. Okay. But here, because you are basically splitting this 1.1 million into the proceeds and the bank discount, which is the bank's cut, which is the difference between maturity value and which is the difference between the maturity value and the which is roughly about 40K, right? The exact number you can easily do. So basically, think about it. So, it took a long time, to get to this point, but the point I was trying to make was, some people might interpret it as, oh, because you are multiplying it by some factor, right? This factor, that's why they call it factoring. Well, some people add their arbitrary interpretation like that. That interpretation is kind of logical. It's logical, but that's not the right that's not the right thing. Okay, factoring doesn't come from that's not the etymology of the word factoring. That's not why it's called factoring, right? It comes from the French and other Romance language term called, facture, or in Italian fattore, or Spanish factura maybe, which means invoice, right? It comes from the word invoice in those languages, right? And this explains, why invoices. I mean, I use the example of promissory note, but invoice, basically it is based on how they discounted the invoice, right? So you may remember from quiz 1, there was a question, one or two questions about this, right? And the question was, the factoring, in factoring, invoices are relevant or irrelevant, right? The question was like that. And of course, the answer is it is relevant, because it's very relevant. Because invoices, right, in discounting accounts receivable, in factoring accounts receivable, right? Invoices, that's what is being discounted, and that's why it is called factoring. Okay. Now, a lot of times, I'm talking about this, a lot of times, English speakers, especially in the United States, English speakers are very limited, means, U.S. citizens, Americans, generally have very narrow view of the world. They generally, most of Americans generally have no second language, no foreign language. At best, it's Spanish, and it's just conversational Spanish. Nothing wrong with that, but people don't, because people learn, if they know a second language, it's not through learning from the book, it's mainly from the street. So they don't have analytical thinking about it. Analytical thinking is what's important. And something like this, where did the word factoring come from? That's analytical thinking. Trying to research and trace the origin, right, in a scientific way, not just, arbitrary interpretation. Oh, because it's by the factor of this. No. That kind of analytical reasoning is very important. And of course, highly educated people have some knowledge of foreign language because it's required in throughout college education and graduate school education. Knowledge of at least one foreign language is required, and they also learn it through books. I mean, they have to um, if you're of second language is French. I mean, not necessarily because someone in your family speaks it, but you learned it from school. You learned it from books. I mean, how often can you have in the U.S. A chance to live next to a French neighbor, right? You wouldn't have a chance to practice French in day-to-day life, but if you know it, you learned it from the book. And if you learn it from the book, you have to cope with it. There is no other way. I mean, there's no easy way. You have to study it. But studying is part of, building analytical habits. But that's what's lacking in average American, right? That analytical thinking, the habit of analytical ability. That's what's missing and absent in the mindset of average Americans. Now, it's kind of off the point at this time because we're not I'm not trying to I'm not trying to say you have to learn a foreign language. But a little knowledge, a good knowledge of a foreign language will take you far. It's not just the because learning it through studying is not just it doesn't just stop at speaking a foreign language, but it builds the intellectual habit. It builds intellectual habit. Okay. Well, anyway, that's the point. So back here, so that explains a lot about the. That brings us to the conclusion about the promissory note and accounts receivable. And the last line item in the current assets is inventory. Now, if you think about it, inventory is physical in nature because inventory is raw material or goods in process or finished good. Excuse me. As I said, in manufacturing, in case of manufacturing, right, the inventory mean these three things in manufacturing. You have to have a raw material, right? And then you have finished goods, and then goods in process. Of course, finished goods will have to be shipped out in your warehouse or in your plant on site. There shouldn't be a lot of finished goods held up in inventory. Obviously, if that's the case, then you're making products that aren't selling. So that's a bad thing, right? So in most cases in manufacturing, inventory would mean raw materials and goods in process. And in retail, inventory would mean only finished goods because it's retail. What kind of retail would have goods in process or raw material? If you go to a clothing store, right, all you see is all finished goods. You go to Macy's, or where else? you go to a Century 21 or malls, all the clothing's there, all the garments, they are finished goods. Can you ever see raw material or goods in process there? Something in the middle of making? No, because they are not manufacturers, right? So the nature of inventory between the manufacturer and retailers are so drastically different. Okay. Alrighty, so that explains everything about the asset side. And in the current liability side, right? Current liability, we already talked about the long-term liabilities, right? And it's easy to understand. It would have to be, loan from the bank, right? Loan from the bank or bonds, right? But in, current liabilities, the line items are accounts payable. Now think about it. Accounts payable is your promissory note that you wrote, isn't that right? If you are the buyer and if you issued promissory notes, that's your accounts payable, right? From your end. From their end, it's accounts receivable, right? But from your end, it's accounts payable. And there are notes payable, like, promissory notes. Okay, so notes payable are promissory notes, clearly. Accounts payable are the invoices that you're holding. In other words, the parts and components that were supplied by the vendors of those parts and components, right? And they just dropped off the parts and components, and together with that, they left the invoice with you. So that means pay this, right? So that's your accounts payable. And accrued, it's accrued interest, and it's kind of accrual as well. I'm still writing with mouse. Interest to pay, so that is, linked to, that should be directly linked to this, right? In the income statement. And then accrued wages, it's generally called, once I use the term accruals, interest should be also part of this. But then I separated it because, that line item must match this line item, right? That line item must match this line item. Accrued wages and accrued taxes, right? Accrued wages, this I explained already in the main lecture. Think about it. Why is there a line item called accrued wages? If you think about it, wages, the paychecks are not paid when the labor is delivered, right? Isn't there? In other words, the paychecks are not on day-to-day basis, right? Between the company and the workers, the transaction is the transaction means when workers deliver the labor, right? Then the transaction is completed. But then the labor is delivered on daily basis, right? Labor is delivered every day. But that doesn't mean one day's labor doesn't make 10,000 computers, right? For example, if this plant's production capacity is like 10,000 computers per month, right? then it will take 10,000. It will take the labor 1 month labor, right, to complete production of 10,000 units, right? Does that make sense? Um, so, but then paychecks are not paid, on daily, but on daily basis, labor is still delivered. But then this is not a temp job. In a temp job, you get paid. For example, you're uh, uh, just working. You can see, there's uh, just manual laborers, who are on the will just get picked up by the there's a corner. I don't know, maybe Manhattan you may not see it, but probably in other boroughs you may see it. There's a street corner, a particular street corner, which is like a rendezvous point or meeting point for uh, daily work hands. And these are usually the illegal immigrants, who cannot hold a permanent job, but just uh, on a daily basis they picked up by this truck, right? um, and the truck is usually the truck driver is usually um the foreman, for a crew that are working on like um, construction site or small construction sites or home improvement sites, and they pick up these workers on a daily basis from a and they are not even on a contract. They just pick up these workers. There's a supply of workers every day, in and they pick them up early morning in a certain street corner. And these people, they get paid on daily basis, but uh, not in this case. I mean, in a computer manufacturing plant, everybody is basically a permanent workers. Everybody is permanent worker, so they get paid uh, uh, monthly or bi-weekly, right? I mean, you would understand if you have a job, you get the bi-weekly paycheck or monthly paycheck. If you get bi-weekly, if you get a bi-weekly paycheck, and it's usually on Friday, right? And if you get a monthly paycheck, it would be on the 25th of the month, or some date. Now think about it. Um, what did I say? The basic operating cycle. What did I say is the basic operating cycle of the businesses? Anybody? Anyone remembers what's the basic operating?
Quarterly,
Uh,
is it?
say that again.
Quarterly?
Yes, yes, quarterly, of course. Yes. And who said that?
Jodianne.
Okay, Jodianne. All righty, Jodianne, I'll give you 0.25 for that answer. Today is 19th, right? Yes, quarterly. So, but let's assume that although that is basic operating cycle, but let's assume this is monthly statement, and then in a monthly statement you will have um, and the statement has to be updated. Also, it's called, it must be closed. They must close the book, right? Or that means simply they must update. They must update the statements uh, at the end of the month. And then the end of the month is not necessarily Friday, right? Let's say it is, Wednesday. End of the month is Wednesday, and just last Friday they got paid. So that means, this Wednesday, which is the end of the month, is the first week of the next biweekly paycheck. So then that means, for the paycheck to go out, you will still need to wait uh, uh, the rest of this week and the next week, right? But this month has to close already. This month, the book has to be updated. So then, you might wonder, is that a difficult thing? I mean, how much, whatever, whatever whatever salary has accrued until Wednesday, don't we simply need to record it? Yeah, we simply record it there, but it is called accrued wages because actually no transaction has been made yet. In other words, normally what goes into the statements are the transactions that have been completed. Now, this paycheck, this period, will be paid out 2 weeks later. And the end of the month is Wednesday. So the next paycheck will have to wait until next Wednesday, not this Wednesday, right? This Wednesday is, next Friday, not this Friday, right? People usually, when I ask students, generally people confuse people are confused by the word next. I mean, if today is Wednesday, this Friday, coming Friday is this Friday, not next Friday. Isn't that right? If today is Wednesday, the upcoming Friday is this Friday of this week, not the next week. But some students call it next Friday because but that's not logical, and it's because they are not thinking logically. If today is Wednesday, it is this Wednesday, isn't that right? Wednesday of this week. Any day this week is this Tuesday, this Monday, this Wednesday, this Thursday, this Friday, this Sunday, right? Makes sense? And Monday through Sunday next week should be called next Monday, next Friday, next something. But some students just, say next Friday to mean this Friday, actually. That means they are not thinking logically. If you think about it, it is this week. It's the day, Friday, belonging to this week. So you should call it this Friday. So what I'm talking about is the paycheck will come. The paycheck will come out next Friday, and today is Wednesday of this week. So you still have like 10 days left until must be, to be exact, Monday through Friday is 5 days. And then we still have
9 days left, I think. Is it?
9 days, yes. So in other words, transaction will be completed 9 days from now. no check has been issued as of today. But because today is the last day of the month and they have to close the book, they will have to record the accrued wages as of this Wednesday, right? So you might, if you don't think, what's the problem with that? As I said, there's a problem because that transaction, in other words, no paycheck has been sent out as of Wednesday, right? Paycheck will be sent out only 9 days from now, next Friday, right? So that's why it is called accrued wages. Accrued wages means, it's accrued, only accrued up to that point, meaning that it doesn't necessarily mean the transaction has been completed. Transaction has not been completed, but you still enter that line item there because as accrued item, as accrued line item. Okay, that's why it is called, accrued wages, accrued taxes, accrued interest up to that point. Okay, so that explains everything about the balance sheet. Now, what's important is I don't know if I have time for the miscellaneous adjustment, because I'm going to come back to that later. So here, what we want to know is because when we started out, let's see. Yeah, I'm doing it with my fingers, I'm enlarging, blowing up the screen. Now I guess I can use it. So the point is, our first topic was return on investment, right? And then we talked about, holding period return and annualized return. Of course, you're annualizing the holding period return, but in the first topic, we looked at it in macroeconomic perspective. In other words, interest rate. Interest rate is the from macroeconomic perspective, this is the bottom line of all, rate of return or return on investment, and how it is, determined. So how the interest rate is determined, right? The monetary policy, Fed funds rate, the monetary policy, and everything related to that, bonds, bond market. Then in topic 2, it's why did we suddenly, started on the financial statements? Because it's still about return on investment, but from macroeconomic perspective. In other words, from the company's perspective, how do we define return on investment from a company's perspective? Now, and to understand that, we had to go into the fundamental analysis. Fundamental analysis means, basically analysis of the balance sheet and income statement. And to do that, we need, I've been telling you, we need 2 balance sheets, balance sheet at time 0 and balance sheet at time 1, and 1 income statement. That's the income statement and time 1, because obviously income statement is always as of the end of the period, end of the operating period, right? You have operating activity during year 1, so then income statement is the description of what happened during year 1. So then income statement the result, everything in the income statement is basically testament to the operating activity of year one. So that would be as of the end of year one, right? So you need, balance sheet at time 0 and balance sheet at time 1 and income statement at time 1. And from that, what are you trying to figure out? What are you trying to what are you looking for in that uh, uh, financial statements? Return on investment from the firm's perspective, from the company's perspective, are two things: return on equity and return on assets. So how do we calculate return on equity and return on assets? We're going to talk about it after the break. Now it's 11:50. Yeah, so I think it's a good time to take a break. So let's take a 10-minute break and reconvene at 12, exactly at 12 sharp. Okay, so I'm going into a break. All right, we're back. We're back. So, um, oh, so, uh, re- so as a representative indicator or indicator of uh, return on investment from firm's perspective, two representative these are ratios basically, and two representative ones are return on equity and return on assets. Okay, return on total assets actually. So from the firm's perspective, right? Think about it. What is the biggest factor to tell? What's the biggest factor of return? Now, if you think about it, the biggest factor that determines the return is the profit, the net profit, right? Net profit, which is also called EAT, right? Uh, the biggest factor that constitutes um, return on investment is the profit. Well, the bigger the profit, the higher the return. Um, but then next question is, uh, profit is a kind of output, isn't that right? Profit is an output. Um, yes, profit is an output. Um, and if there's an output, there must be an input. There must be there has to be an input to have an output, right? So what is the input? Now there are two types of, so this is output, right? And the input can be either, of course, total assets is the input. If you think about it, um, and I've been telling you over and over that a company is a vessel, right? It's a vessel for what? Transferring profit to channeling the profit to the owners of the company, right? Company is uh, company is not a company is a legal entity. It's a legal being, but it's an inanimate being, right? Company is why? Because the actual animate being behind the company is the owners, isn't that right? And the company is nothing but a means of production. Company vessel, meaning it's just a means of production, means of channeling uh, output or the profit to the owners, right? And then I've been telling you, in our example is a manufacturer, right? A manufacturer like Dell Computer. And basically the total assets, why do we want to know the total assets? I mean, why at the bottom of the balance sheet, why is it total assets? Of course, total capital you raised, right? The capital you raised transformed into total assets. And of course, capital, in our example, the physical assets, which are plant and equipment, mainly plant and equipment, which accounted for 95% of the total assets, right? In our example, in this example, right? You raised, it's almost 10 million, right? It's almost $10 million. And you raise this 10 million, You raised this 10 million through equity and debt, from equity and debt. And what for? Because of this plant and equipment, land, building and land, which account for, like, before depreciation. Depreciation happens over time one and time two, time three. But if this is at the beginning, at time zero, the total amount of total dollar value of the fixed assets, plant and equipment, was like, and building and land was 9.5 million. So out of $10 million total asset, out of $10 million raised, right, through equity and from equity and debt, almost 95% of it is held in the form of physical assets, right? The other 5% is held in working capital, right? So it's obvious. In manufacturing, plant and equipment is the physical capital, the means of production, right? The means of production. And the main assets, fixed assets of this company, which exist to generate income. And I've been telling you, assets must have income generating capability. Other than anything else, no matter what the verbal definition, no matter how they define assets, if they don't have, if you just look up, accounting terminologies like assets, something that has value, something that has monetary value, it's not wrong. I've been telling you, it's not wrong, but it's missing the. It's kind of, it's avoiding. I don't know, unintendedly avoiding the critical point. The critical point about asset is it must generate income. It must generate income. If it doesn't generate income, it has zero value as asset. Think about it. If you have, maybe I use this example, 100 square feet of land in Midtown Manhattan. It must be, you must have paid Midtown Manhattan, that's the real estate value of even the empty lot, 100 square feet empty lot, would be huge. So you must have paid a lot of money to own that 100 square. And 100 square feet is nothing, actually, if you think about it. It's just 10 feet by 10 feet, which is not a very big space, right? 10 feet by 10 feet, or it's like 3 meters by 3 meters. So 9 square meters, about 9 square meters, right? Not a big space. And I said, you can probably park 3 minis. I mean, but first of all, you must have paid a lot of money. But then, if it is, as long as it remains an empty lot, idling, it generates no income. Then in that case, it's called non-performing asset, right? The asset, but if you start, even if you park, like maybe in 100 square feet space, you can park 3 minis, but then it will start generating income, right? If you build a 20-story parking structure there, which would be easier and cheaper to construct than a building, right? And what kind of building can you build on a 100 square feet, right? That is, even my room is, I guess, even my study. It's my, even my, I mean, is my even my office space, or even my room, my study, in my at my home is, I would say, at least 200 square feet. At least my office space, probably 200 to 300 square feet. So 100 square feet, you can't build, any right, building, any decent building there. But maybe, parking structure would be a good idea. Maybe, 20-story parking structure. It would be much cheaper to construct, and it will take won't take long time. It will just take probably 3 months. And then if you have 20-story parking structure, you can park like 60 cars. That will generate huge income, right? It's like what? Last time I checked, it was like $25 an hour to park in Midtown Manhattan, or 1 hour per hour. So think about it. Total assets exist. Assets exist to generate income, right? And so that is the input. That's the input, and the result of that input. The outcome of that is the output, and the output is the profit. Of course, the profit here, I use the symbol pi for profit, and that's net profit, right? Net profit, which is EAT. But then, is this is total assets the right input for that? Let's say it is the right input for that for now. And then if you can, if you think about it, and if you think logically, yeah, that makes sense, because this is this is like the productivity, measuring productivity of the asset, right? The higher the profit for the given input, right? The higher the output for the given input, that means the productivity is higher, right? And it's like gas mileage. If you think about gas mileage is a very good example of what they call in general output to input ratio. Output to input ratio. Now think about it. This is exactly output to input ratio. It's exactly output to input ratio. And this is input. The same goes for gas mileage. What is gas mileage? Gas mileage is literally, how many miles you got on a full tank of gas. And your full tank of gas may be, number of gallons, right? Number of gallons, Let's say the fuel tank of your car holds up to 20 gallons. And you drove the car until you run out of gas. And how many miles you got? You got 600 miles. 600 miles. Then we know the gas mileage is 30 miles per gallon. Right? It's simple. It's 30 miles per gallon. And it's called also fuel economy, right? Or fuel efficiency. So, look, think about it. efficiency is another term for productivity, if you think about it, right? Of course, high productivity. I mean, highly productive machines are highly efficient, but if the productivity is low, then the efficiency is low. Nobody wants low efficiency. Everyone wants high efficiency. Yeah, that's why we uh, care about gas mileage, right? Nobody wants, I mean, I know there are big SUVs. People like big SUVs. They drive just, 1 mile from home to work. It's just 1 mile. But they drive, something like, Cadillac Escalade, Ford Expedition, which are huge, which have like 5-liter engines, right? 8-cylinder V8 engine, V8 5-liter engine, gas guzzlers, right? And they get like, probably 10 miles per gallon, 10 miles per gallon, right? So in terms of gas mileage, they are very poor. And then they don't, it's just 1 mile. And then back and forth is just 2 miles. And then after work, they go to the gym. And the gym is just 1 mile away. They drive. Instead of, walking, I mean, if it is 1 mile, it's not a big deal. I mean, the average speed of human walking, right? If It's a known fact, a human being walks at 3 miles per hour. That's the average, speed of human walking on their two legs. So if you walk 1 hour, you can do at least 3 miles. If you walk faster, if you double down on it, you can walk 6 miles an hour. And if you make a round trip, even at average speed, you can make cover 6 miles, which is a decent distance. And if you walk fast, making a round trip, 12 miles. Oh, that's a very decent, I mean, if you do at least like 8 miles, then from that point on, 8 miles, 10 miles from that point on, your feet will get so tired. You will have to take a rest, of course, and you'll have to take off your shoes and take off your socks and give your feet some rest. And if you have good, walking shoes, probably you don't have to do that. You won't have to do that. But some people drive just 1 mile from home to work and just 1 mile from work to the gym, and from gym to and from in the gym they don't do much, workout. They just um, uh, do a couple of push-ups and weight training, and then they eat a whole bowl of salad. I mean, nothing wrong with salad, but the point is, people complain. I work out in the gym every day, but I'm not losing any weight. They complain. Oh, you don't have to go to the gym. Why spend money on the gym? Walk 6 miles. If you walk 6 miles a day, right? Round trip. I mean, if it is not, because as I said, average speed of human being, right, walking on their two legs is 3 miles an hour. So if you just make a round trip, that's 6 miles, 2 hours. I don't think maybe not every day, but even every other day. I can't even do it myself. But, I try to walk like 12 miles, 12 miles at least, once a week. But the whole point is, some people some people like big SUVs, regardless of the gas mileage. Sometimes, they get just, 1 mile per 10 gallons. For 10 gallons, they, of course, that's not a car. That must be a tank. Isn't that right? If you get just 1 mile for 10 gallons, that must be a tank, 72-ton tank, right? But only in America, people, there are people who, right? Um, there are people who have their own collection of tanks, not plastic scale model, but real tanks uh, with live ammunition. I mean, in places like Kentucky or Tennessee, uh, where the land is cheap and people have their own collection of a military surplus or military discard, like old 1960s 1970s tanks. Sometimes they have their own firing range because the land is so cheap. They have so much land. They have in their own private property. They have only their own firing range, and they drive their tank and with live ammunition they fire it. Uh, they have collection of tanks from World War II all the way to up to like modern Gulf War M1 Abrams. But whatever. If you care about gas mileage, right, you wouldn't drive a huge SUV like Ford Expedition or Cadillac Escalade. Um, uh, if you are a person who values efficiency, efficiency is nothing but output to input ratio. And the gas mileage is one good example of output to input ratio. And the mileage, sometimes the mileage is a metaphor. They use it for not just for gas mileage, but uh, in a figurative way. Figuratively speaking, also this is when they say, also this gets you the best mileage. What does that mean? This gets you so out of these 5 options, this option A gets you the best mileage. You're buying a house and you have 5 candidates, and the realtor is telling you, okay, of all these 5 houses, house number 1, this gets you the best mileage. What does that mean? It doesn't mean, of course, physical gas mileage. It simply means most value for money. Most value for money, isn't it right? Most value for money. Best mileage means most value for money. So it's a metaphor. It's also used as a metaphor. But the point is, it's measuring the efficiency. It's output to input ratio. And then if you think about it, no, I'm not trying to move it around. But this I can. So then, therefore, return on assets and return on equity is a basically output to input ratio, and then return on total assets. That means, as I told you, total assets is the input, right? Because all the assets basically exist for generating income. But then in this case, ultimately it would be the net profit, but the more appropriate output for that total assets is EBIT, earnings before interest and taxes. Okay, why? If you think about it, profit belongs only to the equity holders, the owners of the company, right? Profit belongs to the owners. But then total assets isn't only equity, right? Total assets include equity and debt. So then what about the debt holders or the lenders or the creditors or the bondholders? Okay, they all mean the same thing. Bondholders, lenders, bondholders, creditors, debt holders, lenders. They all mean the same thing because it's just that. Now think about it. From the debt holders' perspective, this has nothing to do with them, right? From the debt holders' perspective, what's more relevant to them is the operating profit or EBIT. Isn't that right? Because EBIT includes interest. Interest is basically the payment to the debt holders, right? So only operating profit is the more relevant output for the total assets, okay? And to be more specific, it's the EBIT at time 1, and input is the total assets at time 0. Why? It's nothing new. It's just that I'm trying to. Oh, why am I still using the mouse? I can use the pen, but then operating profit over total assets. Total assets at time 0. Now think about it. What the original input, the profit is the result of the workings of the original total assets at time 0, because total assets at time 1 is not. I mean, that's not the input for profit at time 1. I mean, total assets at time 1 will be the input for output at time 2, right? Think about it. What you invested at time 0 will result in output at time 1, right? It's the same concept as, think about it. Why we are dividing when we are doing when we are calculating one period return, one year holding period. What do? We will first find capital gains, which is P1 minus P0, and then plus the cash flow, all the cumulative cash flow during this period. And then we divide it by P0. In other words, of course, we know that this is capital gains. And then, if you think about it, what's going on? If you think about it, it's really not easy to. Capital gains and income, that's the output. Isn't that right? That's the output. And this is the input. That's the input, right? So, so it's the same idea. It's the same concept. I mean, when you are on the top of the mountain, you know, everything, you have the bird's eye view. You have the vantage point. And from the vantage point, you see the connection between everything. When you are climbing up the mountain from the foothill, right, from the bottom of the mountain, and the mountain would have, you know, like north side, north face, south face, east face, west face. I mean, the mountain would look different from different directions. So you think, you know, they are all different things, and you fear that you have to memorize all these, you know, different things. I mean, just like, you know, that mountain analogy, when you are starting to learn, when you're at a lower level, you don't see these connections between all of them. So you think you have to memorize all of them, so it's daunting to you. But actually, they are not different. I mean, if you are on top of the mountain and you see how all different aspects of the mountain are interrelated, right? They are interrelated. So although the basic concept of holding period return may seem a little bit different from ROA and ROE, no, it's the same thing. Basically, it's also output to input ratio, right? Output to input ratio, and this is output to input ratio. And again, I'm telling you that the return on for return on total assets, right? The appropriate output is operating profit, EBIT, not the net profit, because net profit belongs only to the equity holders or the stockholders. Not to debt holders. So from the debt holders' perspective, right? And debt holders or equity holders, they are only, you know, two types of fund providers. I think there was a in chapter 2 problem on Connect, chapter 2 problem, there was a question about return on fund providers or asset providers. And then if you think about it, return on, most of the time, return on equity holders, which is ROE, right, is only the appropriate measure for equity holders, because eventually, for equity holders, what did I do? Something I shouldn't have. Okay. For equity holders, the net profit belongs to only equity holders, so it's appropriate for equity holders. For stockholders, right? Again, I keep doing this. EAT, net or the net profit, is the appropriate measure, output, measure of output, and their input is equity at time 0. Okay, EAT at time 1, which is now net profit, also called net profit time 1, and equity at time 0. Okay, so these are two main measure of return on investment from the firm's perspective, right? And these are two, ROE and ROA are two representative ratios for profitability. But in profitability category, it's in ratios, there are 5 categories: profitability category, liquidity category, asset management category, debt management category, and stock valuation or market valuation category. And the other categories, we're not going to talk about it in this class, but it's the topic for Finance 230, and also as well as for Business 210, ratio analysis. But if you, in finance, we only talk about 2 representative ratios in each category, but actually in Finance 230, we go more into depth and talk about other ratios. In, for example, in profitability category, there are return on capital, which is slightly like return on total assets, and return on sales. And if you think about it, return on sales is profit margin, right? Because it's net profit over EAT over total revenue. Sale means revenue, right? And then that's, profit margin. Return on capital is, again, EBIT over long-term capital only, long-term capital. Think about it. The difference between asset and capital, and I mentioned this, total assets, of course, don't think about, when I say total assets, don't think about only the asset side, which breaks down into current assets and non-current assets, but also think about the source of the capital, source of those assets, right? Which breaks down into liabilities and equity. And liabilities breaks down into a long-term debt and short-term debt. And short-term debts are, notes payable, accounts payable, accrued wages. So they are not really capital. Capital means always long-term. Long-term funding is the capital, right? So only the equity and long-term debt are capital. So return on capital will be greater than, if you think about it, will be slightly greater than return on assets. Will be slightly greater than return on assets. Why? Because return on assets, total assets is slightly greater than total capital because of that, short-term liability part, right? Okay, so our time is up. That's it for today. Any questions? Any questions so far? Any questions? Okay. All righty. We have any question? Okay, Jodianne.
No, I do not. No, I'll post in Blackboard if anything.
Okay. All righty. So I will then I will see you guys on Thursday. Have a great rest of the afternoon. Uh, uh, Take care, and I will stop sharing and stop recording and sign out.
Bye,
All
Professor.
right.
Have a good day.
All right. Take care,
Have a
everyone.
good
Take
one.
care. All righty. Take care, Brandon.
Bye,
All
Professor.
right. Take care, Julian. All righty. I'll sign out. I'm signing out.